Welcome to the webinar. We'll get started shortly. Before we begin, here's how to earn CPE credit. Unlike traditional CPE webinars, there are no polling questions or attendance checks during the presentation. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz in the Earmark app. Search for the free Earmark app from the App Store or Google Play Store, or scan the QR code on the screen. Open the app and create an account. Be sure to use a valid email address because we'll email you your CPE certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. If you don't see the quiz yet, don't worry. We'll email you when the quiz is available. Complete the quiz to earn your CPE certificate. If you have questions or need help, email us anytime at support@earmarkcpe.com. Now, on to the webinar.
Hey there. So this is Catherine Tyndall. We're going to be doing Escape the Coming ERC Nightmare, Tax Pros and CFOs Due Diligence on Third-Party Claims. I wanted to start off with, who is this course for? So this is really designed, I designed this for any organization or tax professional working with an organization that has previously filed an employee retention credit claim and they're concerned about IRS scrutiny. And I think, to be more specific, who are the people that I'm seeing have the most problems in this program? These are organizations who are pushed by their payroll provider to file based on a questionnaire, so not a lot of due diligence done. Organizations that were pushed by a non-tax firm from a peripheral industry to do the filing. So I'm seeing people from banking, insurance, HR, a lot of attorneys who don't have a background in tax work that were pushing these credit filings. Organizations where they signed paperwork saying that the ERC provider wasn't certifying their eligibility, where they signed paperwork that the ERC provider wasn't giving tax advice, that they dealt with salespeople instead of tax professionals, or they filed under supply chain restrictions or CDC recommendations. So if that's your organization or client organizations, you'll want to tune in for this because there's a lot of problems I've been experiencing. So what is the ERC nightmare? It's basically that the IRS comes and inspects a claim that you weren't eligible for or that you can't defend, triggering a payback of not just the credit, but a whole host of other fees related to it and interest and penalties. So just to give you an example, to give you some context, this is from an actual client scenario that we had to see, well, what would be involved with this if this was wrong? So let's say that you got $100,000 of an ERC credit that ends up getting audited in 2027. So this is after the statute of limitations on the 2021 income tax returns, and they find you ineligible. So the fees that you would have to pay kind of associated with this whole project would be the ERC claim itself would have to go back to the IRS. The consulting fee that you paid would be a net cost that you lose because, if you paid somebody to do this work and then you have to pay the fees back, you're not going to it's hard to get those fees back. When you amend your income tax returns, you pay income tax on the lost wage deduction from these, so that, assuming a high tax bracket, that could be another $37,000. You have estimated compliance costs with having to file amended returns, and then the interest and penalties, depending on when the IRS assesses this, it does the audit. I used the longest period possible for this one. It really racks up quickly. You can see $50,000 on a $100,000 credit amount. It just gets really crazy really fast. And then you'd also have to pay to defend yourself for this audit. And so the total cash out of pocket, just as a scenario on a $100,000 ERC claim that totally backfires, you could be out an additional $137,000 from your initial, beyond just what the IRS had paid you out in the claim. So this could be devastating for a small business. And this is what the nightmare is, because the IRS can come in, determine that you're ineligible, charge you all these interest and penalties, and you really have no recourse. And just to give you some background too on, these are the posted, this is directly from the IRS of, what are you at risk for if you don't take advantage of some of these programs that they have for settlement? What are the penalties we can charge you? And you can see those are staggering, the interest rates and the failure to pay, failure to file penalties that they can impose on these. So this can be devastating for a small business if they end up having an ERC claim where they have to return the funds. And especially if this is a couple of years after the fact where they've already used the money, how are you going to come up with that? So how do you determine if you are eligible? And how do you determine if you have the right paperwork to defend yourself? Because it's one thing to be eligible for the program, and it's another thing to be able to reasonably defend yourself in an IRS inspection. Or what if you aren't eligible for it, but you could have taken advantage of some of these settlement programs that the IRS has? How do you know? How do you know that the money that you got was good or not, and that you can rely on that? That's what this presentation is for. And then for my tax pros who are in the audience, us as tax professionals, what do we need to consider? Because it's a nightmare situation for me to have to tell a client, at the end of the day, you have to pay this all back, and they're in hot water with the IRS. That alone is a nightmare for me as a tax professional. But on top of that, the IRS has really put a push on the tax profession to help them with the cleanup that needs to happen within this tax credit program because of just the rampant erroneous filings that have been happening. And so they did an Office of Professional Responsibility announcement a while back where they basically said, you as a tax professional, if you're encountering clients that filed for these ERC funds, and now those clients are trying to get you to amend income tax returns, you can't just go ahead and file that amended income tax return. You need to do a little bit of due diligence on these ERC funds, because if you know things about the client and, it just seems, it doesn't make sense what they filed for, you're violating your due diligence requirement to that client by filing those amended income tax returns, even though you weren't a part of the ERC filing at all. They're trying to pull us in the tax profession to help them with the cleanup piece. So as a tax professional, that's an added layer of stress in the program. So my course objectives today, I'm going to make sure that you know all the red flags. I deal in this, with a lot of different client scenarios, and I'm really more interested in keeping things at action level. I have a lot of slides to get through that are going to have a lot of dense information, but I'm going to try to keep everything very high level and more conversational in the presentation, because you can always go back and look things up. It's just, I want the red flags to go off at the right time for you to know, hey, I need to look into this more. Oh, this doesn't sound right to me. That's more what I'm interested in. But in the slides, you'll have a combination of the original guidance and all the tax jargon and citations that you want. So my background is, again, my name's Catherine Tyndall. I'm a CPA. I'm one of the principals at Dominion Enterprise Services. We've had over 15,000 people attend our continuing ed presentations, CPA Academy, Intuit, Earmark. We're a licensed CPA firm with a specialty in corporate income tax planning and niche tax issues like the ERC. I do a lot of work in the Employee Retention Credit Program, but my background is primarily income taxation. So for quick housekeeping on Q&A, there'll be a separate video afterwards for any questions that are submitted during the presentation. We also have, for specific advice that's needed, we can do consulting engagements. I can't give specific tax advice outside of a formal engagement, but there's, I'll talk about how to get in touch with us and how we can work together later in the presentation. So my main points for today, we're going to talk about the basics of the ERC program eligibility. We're going to talk about common issues in the calculation of the credit. We're going to talk about substantiating documentation and then dealing with the IRS. Now, when you're approaching, a client or you're a CFO and you're looking at, okay, this is what previously happened. Here was an ERC claim that happened. How do you start that process? The first is we need to determine whether or not you were really eligible for the periods that were being applied for. Then once you determine when you were eligible, then you determine the calculations. Are there any issues in the calculation? And then the last piece is do we have all the substantiating documentation that we need to actually be able to defend this in an IRS audit? Because if you have a problem on any one of these pieces, you're in for the ERC nightmare. And then we'll discuss dealing with the IRS. So I want to just start with some really high level red flags that I very commonly see in the program. That if you have a claim that you're looking at that has any of these characteristics, you could have some serious problems. So the first red flag that I see is if all quarters were filed for the program, and I'll go through the basics of the program again, but it's the first 4 quarters of 2020 and then the first 3 quarters of 21 for most businesses. If you filed for all of those quarters under non-revenue qualifications, so government order restrictions, that's very suspicious, just because most jurisdictions dropped their restrictions either sometime in 20 or early 21. So it's very suspicious. If you filed with a supply chain disruption, also extremely suspicious. If it was filed without the PPP forgiveness application and you have overlapping time periods, most likely that was done incorrectly. If the person doing the work was not a credentialed tax professional or didn't have a background in taxation work, that's also suspicious. If they're not requesting data to prove the impact of government orders and are just filing based on questionnaires without actually getting more into the details of how things impacted your organization, that's also a big red flag. If they're unable to produce government orders that were used to qualify the business, that is extremely bad. And then if you can see that there was credit claimed for related party wages, so if there's owners that are getting included in the credit and other family members and things like that, when you have a small organization, that's suspicious. And then if they didn't inquire about business ownership or the potential of an aggregated claim, that's also a real big red flag if they didn't get into the owner details. So basics in general of the ERC program. As you know, it's a COVID era federal tax credit program. It behaves within the tax code. That's what makes it so complex to deal with. It's filed with payroll tax returns and it's refundable coming back as checks. The total cap for the program is $26,000 per employee. That's extremely misleading. Most organizations don't qualify for nearly that much, and you'll see the reasons why below. And where that 26,000 number comes from is 5,000 per employee total in 2020, and then 7,000 per quarter for the first 3 quarters of 21 per employee. So 7 times 3 plus 5 gives you the 26. Now, the program window, we're going all the way back to 2020. So the time periods we're looking at is between March 13th, 2020 through September 30th, 2021 for most organizations. And when you can file for this, if you haven't filed for the claim, or if you need to file for more, say you underclaimed, is available until April 15th, 2024 for 2020 claims. So we have almost a month left on that. And then April 15th, 2025 for 2021 claims. So if you underclaimed and need to claim more, you do have some more time. Now there is current, as of the time of this recording, there's some pending tax legislation that could retroactively put the ERC deadline back to this January that just passed. But it's unclear whether or not that's going to pass. These deadlines are what's currently on the books. Now, for companies that were started after February 2020 can qualify into the 4th quarter of 21, but I'm not going to discuss that just because it's not most people's situation. And then not-for-profit organizations can also qualify under similar rules as the for-profit organizations. Now, the basic formula of an ERC claim is the first piece is you determine the eligibility windows under the different testing rules that we have. Once you determine the eligibility windows, then you can determine the eligible wages paid within those windows, because that's the basis for the calculation of the credit. The credit itself for 2020, it's the of the first 10,000 of eligible wages paid within an eligibility window, you get 50%, so that's 5,000. For 21, it's 70% for the first 10,000 per quarter. So you can see the bulk of the credit lives in 2021. Then once you have those calculations done, you apply with the IRS. It's paper tax returns. That's why the wait times are so long. And we'll talk about some of the processing issues that are going on over at the IRS that are making everybody pull their hair out. And then in addition to filing for the ERC, you also need to be filing amended income tax returns, which happens separately from the claim. And that's something that needs to be considered as well when you're correcting claims, is if amended income tax returns have already been filed, do you need to refile them again? And then the last piece with these claims is you have to wait for the IRS audit, which can happen well after the fact. In my example, it was a 2027 inspection on a claim. There's a long statute of limitations on these, which we're expecting to get longer because of just the widespread abuse in the program. So the first thing you need to determine when you're looking at one of these is, do we have an eligible organization? So it needs to be an active trade or business which has W-2 wages, and that's going to include 501c organizations. There are complex aggregation rules that can kick in for companies and nonprofits that have shared management or ownership structures between the businesses. And why is this important? Why is an aggregation an issue? It's a common issue I see missed by a lot of sloppy providers, because when you have 2 organizations that need to be aggregated, it changes how we do the eligibility testing, because instead of looking at each company individually, we have to treat them as if they were one company for all the testing. And so when you look at the revenues, when you look at government orders, these companies, for testing purposes, they sink or swim together. So it's very easy for one company that would look eligible if you had it by itself to then not qualify once you consider it as part of an aggregated portfolio. So this is a really common mistake that can wipe out your whole credit if you have somebody who doesn't understand how these rules work. So common red flags that you may have in aggregation is if the company is held by a family or closely related group of individuals or corporations, and then some of those owners are owning other businesses together. So if you've got, mom and dad and son own a business together, and then son and mom own another business together, you can quickly get into aggregation situations that if you don't understand the ownership structures of these entities, can totally change how you do the eligibility calculation. And so other red flags is if you have employees that are leased between companies, and then even without shared ownership, if companies are co-managed or sharing critical business functions, even if their ownership structures are completely separate, if you have some of these close relationships, that can trigger an aggregation too, and then subsidiary organizations. So once you've determined kind of the threshold of what's the eligible entity that we're looking at, you then go into the testing of, well, what are the windows that we qualify for? And there's basically two main tests that we do. The first is a revenue decline test. And then if they don't qualify under the revenue decline test, then we look at, well, can they qualify under the non-revenue tests, which are not tied to revenue performance? And so you look at each quarter independently. It's an either or test. And once you have a go on one of them, then you're good to go. You don't have to pass both. So the first I start with is revenue declines, because it's the easiest to demonstrate. It's the easiest to defend an audit. And as long as you have financial statements and financial information that has good integrity underneath it and is correctly stated, it's pretty clean to defend because the rules are very black and white. Now, instead of going into the minutia of how you can look at the slides to see the thresholds, and it changes between program years. But there's a tool that we'll be giving out after the webinar that's programmed for what the rules are. So you can take it for a quick spin and see, hey, if I plug in my revenue numbers, what does this actually look like? So I recommend you, if you signed up for the webinar, you'll be getting a copy of that. So you can, just take your numbers for a spin instead of trying to memorize these rules. But in general, how the rules work for 2020, we're looking for declines of more than 50%. So it's much harder to qualify for 2020 under revenue declines, because 50% revenue decline is a lot. And then it's a start-stop window. There's an example here in the slides as well that shows you it. But then for 21, they reduced the threshold to make it a lot easier. So now we are only having to look for more than a 20% decline. And because the 2021 credit in general is a lot better, a lot of organizations tend to qualify in 2021 because the threshold is lower at only 20%. So you compare each quarter to its comparative quarter in 2019. There's also a goofy rule that they put in where you can compare the previous quarter to trigger the quarter behind it. And so what I recommend is just get the tool instead of trying to master what that goofy rule is, because a lot of people miss that alternative quarter election, and you could actually have additional quarters that are eligible for the program that you weren't aware of if the person doing the work wasn't familiar with that election. So there's an example in the slides showing as well the differences that you have, and the fact that you have a quarter that looks like on the face of it it's not qualifying, but under that alternative quarter election it actually is qualifying. So that's why I recommend just use the tool. Now, when you're populating, well, what do I need to include in these amounts that I'm doing for this financial testing? What are gross receipts? For for-profit organizations, it's basically every revenue account that you have, whether it's ordinary income to you or not, and you're comparing them on a gross receipts basis. So you lump them all together. You can pull out return, sales tax, and allowances, but you don't pull out cost of goods sold. You don't look at any expenses. The only piece in addition to, those, return, sales tax, and sales allowances that you can take out are the PPP proceeds, EIDL, and restaurant revitalization fund, or the shuttered venue programs. You pull those funds out. But other than that, you want to keep everything in. And then if they had any sales of capital assets, you reduce the gross receipts for those by the adjusted basis in the asset. Now, if you don't know what that is, ask your tax professional. That's a number that they'll have for you. And then for 501c organizations, what are gross receipts? It's actually different rules. Basically, similar thing though. Any kind of income to the organization, whether it's normal or not normal or investment income, needs to be included. But a common thing I see missed for the not-for-profit organizations is that if you have any investment income, unlike with the for-profits, you actually just use the proceeds from sales. You don't net out the cost of those investment assets that you sold. like you would if it was a for-profit business. So this can be really harmful for the nonprofits, because if they lost program revenues and then decided to sell off, a bunch of portfolio holdings, maybe at a loss even, they're just going to have to pick those proceeds up, and it could end up making them not qualify under the revenue declines. So those are the pieces you want to look at. Common mistakes that I see when people go to do this revenue testing that you have to watch out for is you need to make sure that the reports that you're using and the figures that you're using are in the same method of accounting as your tax returns. So not just how you keep the books internally. Typically, the report that people use is a Q1 2019 through Q3 2021 quarterly profit and loss statement, because that'll show all your revenue accounts. And you need it in calendar quarters, not fiscal quarters, because the testing's done on a calendar quarter basis. And this is an especially common thing that I see screwed up, is for accrual organizations. You need to ensure that your quarterly revenues are correctly stated if annual adjustments are made. It's very common for people to have their books to be correctly stated on an annual basis in terms of revenue, but not have it correctly stated on a quarterly basis if the tax accountant is just doing an adjustment at the end of the year to fix your AR or whatever it is. You need to make sure that each of the quarters, and because we're comparing back to 2019, you need to make sure that your 2019 quarterly data has good integrity to it as well. So for accrual organizations, you really got to watch out for this if you're not, if you're a less sophisticated organization when it comes to revenue recognition. And then there's a qualification example in here. You can see how it's, just depending on what the performance was, you can get totally different qualifications, and it's a black and white test. So once you're over that threshold, I've had people qualify by the skin of their teeth. A $2,500 adjustment would have changed their qualification, but that's just how this part of the testing works. So we start with the revenue testing because it's black and white. The financials are what they are. If they're correctly stated, you either qualify or you don't. There's a second way that people are qualifying, and this is where all the abuse of this program is coming in my professional experience. And this is qualifying under government order restrictions. And basically what I want you to think of when you're approaching, if you're looking at a claim that was filed and you can see that they're saying, oh, we qualify under government restrictions, it's not a standard financial test. It's an argument that you're making. And the specific argument in the code is that operations of your organization or more, and this all has statutory meanings, has a more than nominal impact by a binding government order on the ability to provide goods and services. And so I'll break that down into each of the pieces, but that's the argument you're making. And so it's not a standard financial test, but it's an argument that you need to support with operational data and a government order. And so that initial requirement sounds really vague. So I'm going to break it out into the key components. And luckily we have, these are safe harbor tests from the IRS that they've said, these are the thresholds we want you to show. And, you have good grounds for your credit. So the first component of this is when you're claiming that your organization is qualifying under non-revenue declines, you need to show that there is a restriction coming from a government order that has certain characteristics to it. And then once you have that restriction, that government order that has the characteristics, you then need to show that that restriction is causing a more than nominal portion of the business to be suspended. And we'll talk about what that means as well. But those are the two parts. You need the order, the restriction, and then you need to show the impact of that restriction on your operations. So how do you actually go about doing this? The first place I recommend you start is with an operational narrative, because ultimately the argument that we're making is about how operations were impacted. And so if you're not in the day-to-day operations of the organization, you need to know how are operations impacted by these government orders. From there, you need to find the specific government orders that have qualifying characteristics. That's the first part. And then the second part is that you need to prove those orders had a more than 10% impact through some kind of operational data. And then once you have all that, the impacted duration is your eligibility window. Because remember, we're just trying to determine whether or not the company is eligible for this. And it'll be that specific duration, not the full quarter, like when we're doing the revenue testing. So the operational narrative questionnaire, it's in the slides. I recommend you work through this with people who are in operations. And really the core of what we're looking for here is, what was the true government interference in the operations? So not things like reduced customer demand, not things like employees were staying home because they wanted to be on unemployment, but where was the organization being directly interfered with by government orders. And what did things look like pre-pandemic? What did things look like post-pandemic? And how does that all work together with the orders that were in place and how we were productive afterwards? And basically, we want to show that the operations were being impacted more than a 10% when specifically under these orders. And so the other piece that we have to watch out for as well is that even if you did have a government restriction, if you were able to pivot and telework and didn't end up really having a material impact on your operations, even though you did have restrictions, that's not going to pass the test. So a lot of professional organizations like us accountants, because we can telework, we didn't really experience a 10% disruption in our business by having to not see clients in person because we could just do phone calls or just do Zoom, et cetera. So you have to watch out for that. So once you have a sense of, okay, these were the impacts that we had, the next piece that we look at is what is the qualifying government order? Now, it needs to be a governmental authority. This is typically the state level for most jurisdictions. Some places it's metro level or county level. It's very rarely at federal level. And it needs to be COVID-19 related and limiting commerce, travel, or group meetings. The order needs to be legally enforceable and binding. So suggestions, recommendations, best practices, or voluntary measures do not rise to the level of a legal restriction. And that is why it is essential that you need a copy of the actual government order. You can't just use a news blurb. You can't just use a comment from the mayor or a comment from the governor or kind of what you hazily remember. You need a copy of the actual orders, because the number of times I've looked into client cases where you have two jurisdictions, the clients had to behave the same way, where a must is a should will completely change your eligibility. So it comes down to the specific wording in the order, and that will determine the dates that you have of when that order was enforced. It'll show the level of legal authority that they did have the ability to bind, they had the jurisdiction over the organization, and then the specific language of the restriction, because everything hinges initially on the language of that restriction. Is it a recommendation or is it a command? Very different. And you don't know unless you have a copy of the actual order. So here's an example in the slides. There's an example of a government order from the desk of the office of the governor. It's got his seal on it, and it's order prohibiting gatherings of more than 25 people on premises consumption of food or drink. So you scroll down into the actual language. This was for a church that we were looking at. And you can see in the language specifically, it says, I hereby order the following: gatherings of over 25 people are prohibited throughout the Commonwealth. So that's the restricting language. It's not we recommend. It's not they should. It's prohibited. It's a must. They have to do this. And then when you get to the bottom of the order, it's showing the effective date range, which that's the window that you're then going to look for the impacts in. But that's the the maximum it's going to be for that affected window. Now, a piece of advice for you is you do need to have that order in hand, but I recommend if you filed for an ERC claim, you need to make sure you have this information now, because a lot of these state websites, we're now in 2024, are getting updated. A lot of these orders are not getting, they're not continuing to put them on the web the way they were now that the pandemic's well and over. So you need to make sure you get actual copies of these, because if you get audited in 2027, good luck trying to find that PDF. So you want to make sure you have the physical copies of all these now. And if in the claim work that was done, if the provider doesn't have those or doesn't even have the specific names, because you can see on this one, it's got it's a specific document. If you don't have that, you have no proof that there was a restricting order. And that's the crux of the argument. That's the first piece of the crux of the argument for qualifying under government restrictions. So once you have that order, you then need to show that that order was impacting your organization enough to qualify. So, for instance, if you have things like, oh, we had to wear face masks and we had to social distance and we had to do all these things, how do we know that it had enough of an impact to qualify? Because for some organizations, those factors would be a pretty significant impact on their business. For other organizations, was it really? How do you prove that? So there's two standard safe harbor tests for how to prove it. I'm going to go through these fairly quickly. The first test is the nominal portion test. The second test is the nominal effect test. and basically either can satisfy the IRS as a proof of a qualifying impact once you've got that restricting government order in hand. Now, if you had a portion of the business that was closed, so a segment of the business that was closed, a common example is for restaurants, you have indoor dining, outdoor dining, catering, takeout. You have different segments of that business. If you had a government order that was closing a segment of your business, a full closure of that segment, you just need to show that segment, it represents a big enough segment of your business when you're comparing it to pre-pandemic activity. So you look at, as long as that segment is at least 10% of 2019 revenues or labor hours for that same time period, then you're good. The segment is large enough. You have a more than nominal impact. You have a qualification there. Now, there's an example, if you've got a restaurant with indoor dining that's 50% of their sales in 2019, doesn't matter what happened during the pandemic for, the size of that segment, because if it was closed, even if other segments went up, the fact that segment was significant to the business and that segment was closed by a restricting government order will give you an eligibility window. Now, for most businesses, though, they didn't really have a full segment closure. And a lot of the unscrupulous claims that I see come across my desk will come from people trying to use this nominal effect test of, basically of saying, we had, people were trying to stay home, customers weren't coming in, we had to wear face masks, we had to social distance, we weren't able to get all the materials that we got. There's a web of all these disruptions that everybody experienced. But in order for this test to work, you have to show that the restrictions that were happening in the business were specific to a government order. So it can't just be things like drops in customer demand. And then you have to show that the restriction, so not just peripheral chaos of the pandemic, was causing an impact of at least a 10% reduction in the employer's ability to provide goods and services in its normal course of business. That's the specific wording. And so unlike with some of the other testing where we have comparative periods, it's 10% reduction in the employer's ability to provide goods and services in its normal course of business. So it's going to be completely idiosyncratic to that organization. How do you prove that? Because we need to look at what's our normal course of business? What were the restrictions? How did the restrictions change how efficient we were as an organization to comply with those restrictions? And how do we show that we had a drop of 10% in our ability to provide goods and services, comparative. And so that's why I recommend you start with that questionnaire, because that will work out the pieces that you need to help make that determination. And then you need to show the causality between, and you should be able to see it in some data, between the government order and then your ability to provide goods and services, and that it makes sense. It's an argument. You're making an argument that this is what was causing it and this is what happened. It wasn't just general pandemic chaos. And so the IRS doesn't have specific data of, we want a, number of jobs per hour report from you on their, on their IDR. But in our experience, you really do want to have something quantitative that's showing, because they've had this is a very low threshold. They're saying you only need to prove a 10% disruption. And so if that's not manifesting itself somewhere in data that you have, or somewhere in, you can, put together an argument for operationally how it was impacting you, I don't think you're not going to be in a good position for an inspection. And that's why you want to have a quantitative support, because you want to have a tight logical argument for this. Because at the end of the day, when you file for something like a tax credit, the burden of proof is on you as an organization and a tax professional to prove it. It's not on the IRS to disprove you. And so if you're not meeting these safe harbor requirements and you don't have good documentation, they have every right to deny your credit. So that's why it's important to not only make sure that you're doing all the calculations of eligibility correctly, but that you actually have documentation that you can really prove it, and it's a tight argument and it makes sense, and you have all of the pieces lined up. So some examples are things like, if you can show labor hour reports showing that you were losing 15% of your throughput because you were having to do things like sanitization. This was for like a meat packing plant where they were losing hours a day to sanitization requirements from their health board. And so they could show, during this sanitization requirement, we were having to spend 2+ hours a day doing all these other things to comply with this restriction. You can see it in our, in our labor reports. You can see it in how much work we were able to get done. Or things like capacity restrictions. So if you have social distancing and you can show, normally we can serve X number of customers or X number of orders, And because we're only able to have 50% of the population on the warehouse floor because of social distancing, it decreased our ability to fulfill those orders. And you can see it with the throughput in the business. So some examples from IRS Notice 2021-20 that you might want to check out, things like restaurants, retail business, hospitals, grocery stores, and large retailers. It's a facts and circumstances situation, but those can give you some examples to look at, but it's very idiosyncratic to your specific business. And so if the person who filed the claim for you doesn't really understand your business or didn't really go into the weeds with you of what happened during the pandemic, it's very likely that you had somebody that just did the filing without doing this due diligence. Now, what about supply chain disruptions? Because a lot of people filed under that. And why haven't I talked about that? So simplified, when you're qualifying under supply chain disruption, you basically have to meet all of the tests that you normally would have to meet for a non-revenue qualification. And so you still need a copy of that actual government order that was specific to the supplier. You're going to have to beat those 10% tests for your company because that supplier couldn't get you the supplies. And then you also have to show that those goods or materials are unable to be obtained from another supplier. So the fact that you couldn't get materials on the market isn't enough to qualify under a supply chain disruption. You have to line up all of these pieces to prove it. And so it's extremely rare that you actually would qualify under a supply chain disruption. If you did qualify under it, there's a piece of guidance that I'll reference at the end from the IRS that goes through specific examples. But in my professional experience, of all the cases I've filed, I've had maybe one or two that were able to use this provision. It almost never works just because it's so specific what you have to prove to qualify under it. I almost wonder why they even included it because it just confuses people. It almost never works unless you have very specific materials that you get from a supplier and you can find an actual government order that was causing those disruptions. And it wasn't just general chaos from the pandemic. So once you have all those pieces together for a non-revenue qualification, the window of when you have those orders and when you're beating the test, even though the credit is still applied for on a quarterly basis, the actual range of your eligibility is the specific date range of when those orders were impacting you. And it's very often for those to be messy time periods. It's often to have multiple orders that were happening it makes it a lot of digging. So common pitfalls and best practices that you need to watch out for is if you have an aggregated claim and that wasn't caught, now you can see why that's a really big problem, because when we're going to do this testing in these orders, if you have multiple businesses that you're now having to combine and say you had a business where they had a 10% impact themselves, but then once you combine it with the rest of the portfolio, that 10% impact only goes down to a 4% impact, you're now no longer meeting those safe harbors and you're not qualifying. You also have to watch out for operating in multiple legal jurisdictions, because you might have had orders that were binding on one part of your organization, but not binding on another part. And how do you measure those relative impacts? So it gets confusing very quickly. So that's why you really want to question any practitioner or person who is filing these that's not producing specific government orders for eligibility. That's the easiest way to catch it as a problem, because if they're not able to give you the specific government orders that they were using, there's no way they did any of the rest of this testing because it all hinges on that. So even though it requires a lot of legwork to qualify under these provisions, it is a real pathway. And because we have these safe harbors, you can prove it in a black and white manner, in my opinion. But you really need to substantiate, and realize that the audits are going to be coming over the next couple of years. And if you don't have this paperwork in order, the IRS is just going to throw it out of hand. So those are the things you got to watch out for. And I know we've already spent a lot of time on the basics of the eligibility. That's where most of the problems are with this program. So that's why I spend so much time, because that's where you're going to run into the most issues, specifically around the government orders piece. Now we're going to breeze through the rest of these here. So key components of how to do a calculation. Like I said, you start with that eligibility window. Then from there, we determine eligible wages, and then we exclude certain things from those wages, and then we do the calculation of the credit. So key components for wages. Now, if you're an employer that had over 100 employees in 2019, there are different rules. I'm assuming that's not you if you're watching this. If that is you, you just need to engage some professional tax assistance, just because you're dealing with potentially $1 million life and death ERC credits, which is not a good place. But for eligible wages, the general principle is it's Medicare wages plus health benefits less wages used by other aid programs. So the notable exception is the tips credit for restaurants. And then you need to remove wages for non-eligible persons. There's a slide in here that has a whole list of what wages work and what wages don't. And then notable exclusions you need to watch out for that can get missed on claims is if you have guaranteed payments to partners, those are not technically wages. If you have wages that are paid that are not Medicare wages, you're going to run into problems there. And then wage payments to related parties. This is a really common one I see get missed for smaller companies, and also for claims that were filed early on in the ERC program, just because this rule specifically was not clarified by the IRS right away. It took them a while to come back and say that, related party wages don't count. So we'll talk about that. And then the last one that I see common mistakes and just gets missed, especially by really negligent ERC filers, is PPP forgiveness proceeds exclusion. So we'll talk about that. So what are related parties? So if you have an owner in a business who has directly or indirectly an over 50% ownership stake, their wages do not qualify for the credit. Now, any wages to family members of those more than 50% owners also are not going to qualify for the credit. And then any shared family ownership attributes to each other. So the easiest way is just say an example. So say you have a husband and wife who own a business 50-50, and then they have a son who works in the business. Because they have that related relationship, that 50-50 is actually considered 100-100. And so the husband and the wife wages would not count. And then also the son, because he's a family member to them, also does not count. So those three people's wages do not count towards the base for the eligible credit, which is really unfortunate. That's the way they interpreted it, because that mostly dings small businesses who need the credit the most, but that's the way they interpreted it. Who's a related individual? There's a list in the slides that you can review. It's basically anybody who's family, and also people who have live in the same tax household. There's also an example of how the attribution works in the slides if you're interested in that. Basically you just have to add up related parties' interests together, but there's an example. The next piece that I see get screwed up a lot is the PPP exclusion. So the original rules for the ERC program were that you could not do both programs at the same time. They realized that they were basically just making the ERC nobody was going to do it because PPP was better. And so they changed it after the fact to say, well, you can do both programs. We just want you to do a complex accounting allocation to make sure you're not double dipping on the wages. If we paid you for PPP, we're not going to pay you again on those same wages for ERC. Fair enough. But you have to calculate that and make sure you're doing it right. So how do you spot a bad allocation? You want to look at the PPP forgiveness covered period. So if they applied for both rounds, you're looking in 20 and 21. When were the wages that they applied for forgiveness for? And then does that time period of the covered period overlap with their ERC eligibility window? So if they filed for it, filed for PPP forgiveness and used covered wages in the second quarter of 20, and they're filing for ERC in the second quarter of 20, very likely you have a timeline overlap there, and some wages are going to need to be excluded. Now, you have to do a per employee, per paycheck allocation to do that exclusion correctly. But in general, if you see overlapping periods, there needs to be some PPP taken out of there. So those are the common issues in calculation that I see. And so if you've determined that you're, got your eligibility all tightened up, and then you know the calculations are correct, what's the last piece of the puzzle? It's substantiating documentation, because if you've got you could have totally eligible calculation of the credits totally right, but if your substantiating documentation is not in order, you're not going to do too well in your audit, come a couple years by now. So the best way I think you can tackle this is in the slides, we have a prep and substantiating checklist. These are common documents that we recommend everybody have, that are a combination of what we've experienced in practice, what we've seen on the IRS IDR requests, and then also just general. So you can read through theirs of the specific documents we recommend you have on hand. And then the last piece is you want to make sure if you are qualifying under those government orders that you have substantial operational data that's documenting the impacts. So you want to have things like labor reports, whatever you use to determine that more than 10% impact. You want to make sure you've got copies of all that data. You have some kind of write-up that's explaining the relationship, so it makes more sense to somebody who's maybe not within your organization to understand what the data means, those sorts of things. But you want to make sure you've got that in place. Now, also in the slides, we've got, this is directly from the IRS Notice 2021-20, gives a list of what they'd like you to have on hand. And note the second piece there is any government order suspending or partially suspending operations. It's the second thing that's on the list. So make sure you've got those physical government orders. This is an old information document request from the IDR for an ERC audit. So you can review that as well. But that's also rolled up into that other list that we had. But you can review this as well in the slides for documents that you'll want to have on hand. And you really want to make sure that you're going through and you have everything, just so that in a couple of years from now, if it gets opened up again, you just have everything already, categorized and ready to go, to be able to submit it over instead of scrambling to try to get these things last minute. So the list is in there. So that's the substantiating documentation. We recommend just review the slides because there's a lot of different pieces that you want to consider. So the last piece that I'm going to spend the rest of our time today talking about is dealing with the IRS and how do you correct incorrect filings? Because at the end of the day, you look at an ERC claim, you want to do due diligence on it and see, okay, what did we actually qualify for? Do we have the right documentation? Maybe we are eligible, but we really don't have good documentation and we don't want the exposure of an IRS audit. How do we correct this? So the first piece I recommend is if you are subject to a fraudulent or a negligent claim, the IRS is recommending that you file a form for reporting suspected abusive tax promotions. This is basically to help them try to catch people that were doing inappropriate filings, that weren't doing any due diligence, that were, pushing people into these erroneous filings. So that's the first place that you can start. And there's a link to the guidance from the IRS on that. So you can start there. And then as you're going and considering all these corrections for the ERC claim itself, you need to keep in mind the income tax situation as well, because if amended income tax returns have already been filed for this, whatever you do in a subsequent ERC correction, you want to make sure is going to be reflected on those amended income tax returns because the statute of limitations runs on those faster. You don't want to be paying back an ERC, but then you also, paid income tax on something that you're returning. So always keep in mind your amended income tax return situation. And then there's a flow chart here in the slides for what do you do for an incorrect filing. So what you do is, as I said, we do all the testing on a quarterly basis of whether or not you qualify. You do the corrections for these in a similar manner. You look at each of the quarters that were filed for and you determine, is the whole quarter ineligible? So did they say that we qualify under supply chain disruption and that was total baloney? And so the whole quarter just doesn't count at all? Or is the quarter partially eligible? We had a government order, but the government order stopped mid-quarter, but this provider filed for the whole quarter. So we do qualify for something, but not the whole thing. So that's the first thing you need to determine is the whole quarter ineligible? And if the answer is no, you do have some eligibility within the quarter, then you need to go through and amend the existing claim. You want to recalculate your eligibility, make sure all your substantiating documentation is on file. You'll need to file additional amended payroll tax returns. However, you normally file those. Most people, it's a 941X that needs to be filed. You need to pay back any excess funds that you received, and then you need to consider those amended income tax returns. So that's how you deal with correcting a partial quarter. Now, if the whole quarter is ineligible, it makes it simpler. It's simpler for the IRS to process it as well. The next pieces you have to consider is, well, has the quarter been processed yet by the IRS? Did you already get the checks? Did you already deposit the checks? Or are you looking at something that's, been waiting in the wings, waiting to be, paid by the IRS for 6 months, and then you have another tax professional look at it and they tell you it's not appropriate? So you have two options. If the claim has already been paid and you've already deposited the funds and it's before March 22nd, so I'm recording this March 5th. If it's before March 22nd, you can do the voluntary disclosure program. Similar process. You want to collect all your substantiating documentation. You're basically saying, we don't qualify for any of this quarter that we applied for. You prepare a couple of forms for them, which are listed in the slide, a 15434, and then if it's for 2020, an SS10, and it's a specific SS10 that they've already pre-prepped to help them in processing. So you want to use this specific link instead of just Googling SS10. You submit the VDP package, which there's a link to the IRS's guidance on how to do that submittal. You need to pay back any excess funds. Now, they will accept installment agreements on this, which is great. So if you don't have all the funds, you can do an installment agreement. And then if you have already amended your returns to pay additional tax, you would want to amend them again to get that back. But if you haven't already amended your returns, you don't need to do anything with your amended income tax returns. So you can do this before March 22nd. And the benefit, I'll talk about the benefits, is it's not a full payback, and there's a lot less. There's the interest and penalties piece is really nice what they've done there. So that's if they've paid the claim. If they haven't paid the claim out yet, and you're just waiting for them to process it, what you can do if you don't want them to process that quarter because you're not eligible is you can withdraw the ERC claim. You fax a copy of the withdrawn return to the IRS. You return any checks. This also works if they sent you the checks, but you haven't deposited them yet. You can return the checks to the IRS, and then you want to consider again the amended income tax return piece, depending on where you are in the life cycle of that. So how do you withdraw a claim? And this is when the whole quarter doesn't qualify and they haven't processed it, or they have processed it and you haven't cashed those checks yet. So it's a simplified process. You basically write withdrawn on the returns, and then you fax it into the IRS. In the slides, it has the address to go to with the full IRS instructions, which I recommend you review. It's irs.gov/withdraw my ERC. And basically the withdrawal option is open until they announce it's closed, which there's been indications that they're going to close the withdrawal process once they lift the processing moratorium, but it's all hearsay. We don't know what they're going to do. But I recommend if you think you need to withdraw a claim, don't delay. Do it quickly because we don't know when the withdrawal option is going to expire. There's a sample too of what a withdrawn claim should look like, what you write on the returns. But again, go to the IRS page to review that if you're going to withdraw a return, because they might update things as time goes. And so you can withdraw them, or, I mentioned this voluntary disclosure program. So let's talk about that. There's a link on the slides to the page from the IRS. I recommend if you're going to consider doing this program, you fully check out the IRS resources here. They're pretty good. The caveat with this is it's only available until March 22nd, unless they extend it. Now, I've contacted the IRS to request, are you guys going to extend this? Because as a tax professional, this is kind of a slap in the face that you're putting another deadline on us in the middle of tax season, especially for something where it seems like they can't be bothered to process their paperwork on time for people who've submitted legitimate claims. And we can talk about that. But, the fact that they're only letting us file these until March 22nd is a little crazy. But the benefits of the VDP program is that you only need to repay 80% of the ERC that you got. You don't need to repay any interest that they paid you. You don't have to amend your income tax returns. You don't even have to pick up that 20% that they're letting you keep as taxable as income. So it's like a free 20%, and they don't charge you interest or penalties. And they're not going to examine it for the periods that are resolved within the VDP, because you're basically just saying, hey, we weren't actually eligible for this. We're turning it, here's 80%, we didn't, here you go. And then the main other piece is disclosing who the preparer was that prepared it. So it's basically the main gist of this program is they want to get people back into compliance and give them an incentive to do so. And then also, so that they get the information they need to really go after the bad actors that are in this space. So that's kind of the gist of the VDP. But if you're considering doing it, you need to do it right away, because we only have until March 22nd, and check out the IRS VDP page. It's a really good program. It's simple to participate in, and can give you some, benefit of that, letting you keep that 20%, because they acknowledge that a lot of people paid high contingency fees. And it's going to be really hard to collect that money back from these shell companies that have disappeared. So who can apply for this? If your ERC was claimed on an employment tax return that was processed and paid as a refund, and you've already cashed the money, and that you think you're not eligible to any ERC for that time period. So for that quarter that you're looking at. So it doesn't mean that you're not entitled to any ERC, but just that particular quarter that you're correcting. Because remember, we're looking at each of these options on a quarterly basis for each of the quarters. You can't be under audit. You can't be under criminal investigation. And that the IRS hasn't already reduced it to 0. So that's who can apply for it. Definitely check that out. Now, the last piece, which this is going to impact a lot more people, is if you have a quarter that was just incorrectly calculated, or a partial quarter that, needs to be corrected, you need to amend the existing claim. Now, just know when you submit another amended return, the IRS is not currently processing these. So we're waiting for them to announce when they'll start processing these amended returns again, but you'll want to recalculate your claim, get your substantiating documentation in order, file your amended return again, have proof that you filed your amended returns. So, send certified. And you just need to make sure if you're filing for additional credit. So if the person undercalculated your claim, or you have additional time periods that you were eligible for that you didn't file for, if any of it's related to 2020, the deadline of 4/15/24 is coming up very quickly. And then you also run the risk of there is pending tax legislation that could retroactively put it back to January if you have additional funds that you're looking to collect from, additional credit that you're due. You'll need to pay back any excess credit using the instructions from the amended tax return that you're using. And then also, again, consider the amended income tax returns. There's a link in there to the IRS processing moratorium announcement. There's really no good information about when that processing moratorium is going to be lifted, though there's been whispers and rumors that it's going to be this spring. So when it comes to the IRS audits, we've gone through in this presentation pretty at detail, the pieces you really need to watch out for. I just tell everyone you need to assume very high levels of inspection, especially if the provider that you're working for did a really bad job. Typically, the IRS is going to be able to tell all the filings that provider did, and they will probably show up at your door at some point. If so-and-so, ERC wizard, qualified one person under supply chain, and that was inappropriate, they probably did it for a bunch of other people too. So you just want to, if you have a suspicious claim, you want to just make sure that you're getting it corrected as soon as you can. And that, assume that you're going to there's high levels of inspection on these, and have all your documentation assembled now. Because if you wait until a couple of years from now, it's going to be a lot harder to get all of that. And, you run the risk of having a claim that was eligible be denied for the lack of good documentation. So got to watch out for that. And the statute of limitations on here, it's typically 3 years. I expect this to get extended. There's pending legislation that's trying to extend it. Some of the quarters are 5 years. Just assume we're going to be in for a very long ride on this program, because just the sheer scale of erroneous claim work that was done is just astonishing. And it's going to take a really long time for the IRS to clean it up. So just assume it's going to be a long time that they could come back to come back and knock on your door many years after the fact. So I know we're pretty much at time here. Summary of the IRS guidance received. So there's a page in the slides. I highly recommend anything that you're interested in about ERC and want to know, the different places where the IRS have said things. I have the notices in there. If you filed for a supply chain qualification, towards the bottom is the IRS memorandum, GLAM, for supply chains and their interpretation of it. You need to read that if you filed under a supply chain restriction, because, I'm going to go out on a limb here and say it's most likely that you do not actually qualify under supply chain restriction if your provider did that. And also below, there's the IRS VDP guidelines and the withdrawal guidelines, links to their pages on that. So I want to say thank you for joining us. And then what are the next steps? So if you're an organization who has a suspicious ERC claim and you're not sure that you even qualify, or you're not sure that your paperwork's in order, this is something that our firm is doing for other tax professionals and other organizations. We'll also be sending out a copy of that revenue tool that I mentioned so that you can look at that, because it's really the first place to start is, what's going on with your revenue eligibility, and a copy of these slides that have all of the detailed information and little citations and things that you want to look at as you actually approach this process practically. Because like I showed at that beginning slide of, what's the potential exposure on $100,000 credit? You've got a lot of exposure here, even for small claims. And so it's, instead of sticking your head in the sand, you really want to be cognizant of that exposure and dealing with that risk now. So if your organization is in need of a complimentary assessment, or if you're a fellow tax professional looking for some more support, you can get in touch with us through our website. There's a link in the slides directly to contact us. But please do get in touch, because we're trying to help people get into compliance with this program before they experience the ERC nightmare. And if you have exposure, if you had a bad claim, you want to know now and not wait, because the racking up of interest and penalties is just, it's going to be horrendous. So thanks again for joining. That's it for me for today. And then we have a closing piece that will talk about, how to get your credit, etc.
Today's webinar has ended. We hope you enjoyed it. To earn CPE for watching, download the free Earmark app. Scan the QR code on the screen to visit the download page. Open the app and create your account. Use a valid email address where you will receive CPE certificates. Then register for the course. You can search for it by tapping on the magnifying glass icon on the home screen and then entering the name of this webinar. If you're attending the live stream of this webinar, keep an eye out for an email letting you know when the quiz is available in the next few days. Pass the quiz to earn your CPE credits, then tap the button to email yourself a CPE certificate. Stay tuned for more webinars from Earmark. We appreciate you joining us today, and we look forward to seeing you again soon.